Hello and welcome to my first ever Gig Harbor real estate market update newsletter, I guess in video format now. I've been doing the email version of this, as you can see on the screen, since January 19th, 2021. So it's almost 2 years now that I've been doing these weekly, every single week. I mentioned it weekly, every single week, market updates, and I haven't missed a beat, and I just wanted to essentially just relay the information in video format for those of you driving or that would rather listen to me speak, or maybe you're working out or whatever have you. Here you go, here's the content in video and audio form, or if you like reading it, I'll still be doing the newsletter sent out. So really a dealer's choice. So with that, let's get into it. In this week's market update video, we're going to be looking at December's data. And why December? I mean, it's January already, right? Get with the program. Well, it's because the Northwest Listing Service has just released December's data, and it takes them about, the whole month. They aggregate the data and then they release it the following month. So that's why in January, we can now look at December's data. And this lag is inherent to real estate. And unlike the stock market, which has like real time, like you can look at the, the ticker symbols go up and down, and like, on the second basis, it takes a whole month to get real estate data. So that's why there's such a lag in how real estate responds to monetary policy and economic trends. And that corresponds to a very slower cycle than what we see with the real-time data of the stock market, which has, these immediate fluctuations, like the Fed meets and all of a sudden there's these huge spikes and everything. That doesn't happen in real estate. Usually what happens with Fed policy, it takes about 9 months to a year to really trickle through and have its effect on every part of the economy. So that's just something I'd like to mention. And for that reason now I've switched to a 3-month rolling data set instead of a live monthly look. So I'll show you in a second here, but basically looking at just a monthly frame without a smoothing average gives us a lot more noise to look at. And that's good as we see the market changing, but once we've had a trend established, it's nice to be able to smooth out and reduce some of that noise by switching it now to a 3-month rolling average. So yeah, let's go into it. Let's look at the graphs. Okay, with that out of the way, we're going to be looking at, here we go to the screen, Gig Harbor. We're going to be looking at residential property only, and we're going to be looking at previously owned. I don't like to incorporate new construction because, especially in this market, the builders are going through some changes and they will distort the data. So what else do we want to do? As you can see, this is a this is a good segue. This is a 12-month rolling data, so it smooths out the noise. And what do I mean by noise? We can look at live monthly data, so these are the actual figures for that month. As you can see, it's very jagged. And what a rolling month does, it essentially smooths out and averages back 12 months to give us a much more, how would you say, steady line that reduces the noise that the month data gives us. However, if we go back to 12 months, we see that it really doesn't reflect what's been happening in the economy, and versus the monthly data really does show a difference about what's happening to our housing prices. And we've been, I think, since June, so April, we've been in, I think the data now reflects enough recent historical activity to change it now to a 3-month rolling, and that gives us both a smooth data set but also something that's more reflective about what's happening currently in the market. Before I get into the actual data, I just want to explain the difference between the median sales price and the average sales price. So an average sales price, let's say last month 3 houses sold, 2 for $500,000 and 1 for $5 million. Well, if you average those out, so you get $1 million plus $5 million, you get $6 million divided by 3, would say, oh, the average house in Gig Harbor is actually worth $2 million. But that doesn't make much sense. It doesn't give you a realistic picture about what happened to those $500,000 houses. Those are not worth $2 million, and nor is the $5 million house worth $2 million. So I don't like to use average numbers. I like to use median because those are the most frequently occurring. Those give a bias to what we typically see in the market, and I think it's a more realistic understanding about what's happening to most people's houses. Otherwise, one expensive waterfront home can really skew what's happening in the market. All right, let's start by looking what happened this past year. We're going to go to 1 year of data, and we're going to see that between November and December, we've lost about $15,000 worth of median sales price. And it can be inferred, oh my God, the market's crashing. Look at we're going down, just a negative trend since the high in here in June. So we've lost $100,000 since the top in June. But if we really look back a year, we can see that even in 2021, we did have a decline here between November and, well, $16,000. I mean, that's pretty much what we experience now. So I can't really use this as inferring that the market's crashing. I think it's just a typical seasonal norm. And in fact, when we go back over, let's say 10 years, sorry for it's a little bit cumbersome to use this, but we can see here between November and December we lost a little bit. Here November to December we lost a little bit. Here between November and December we actually gained a little bit. Here November, December we lost a little bit. So, it's very typical here between November and December. That's a $4,000 change. It's very, I would say, minute changes. The reason why this is so exacerbated is because the prices have gone up a lot. And, in the future, that might look like a little, blip like it does down here just because the prices keep going up. Because who knows? It's just you gotta use more of a log chart than a linear chart like this. But yeah, that's what we have. And actually, if we just look at 1 year, we're actually up still 5% from where we were in December of last year. So even if you bought last year in December, chances are you're still up a little bit. Okay, the next data set we're gonna look at is new listings, and that gives us a good barometer about what's happening in the market, the energy between buyers and sellers. And let's pull up new listings here. And we're gonna go to, let's just go this year. And it looks like I'm in the way. Let me move myself up here. Okay, here we go. So the one thing that I saw is now we're at 140 listings in December. Let's look at it in historical range here. And it looks like we're pretty on point, but in actuality, all these lows are in January. So the least amount of listings we get are in the year is January. And the fact that we see such low listings in December worries me that we're gonna even have lower listings this month. So we'll probably see maybe 120 or 110 listings. It really depends on the psychology, and 110, that's really 110 families moving. And the people that move in January are usually are people that have to sell. So like estate sales and divorces, foreclosure, or people that have to relocate because of work, stuff like that. It's not the people who want to take their kids out of school and move during the spring or in the summer, because that's when school's out and it's easier to relocate. So that's just an interesting tidbit I saw, that we are actually below seasonal norms. In December here you can see 188, 196, 160, 171, so we're quite below this 140 mark. And in fact, we're down 17% of what we saw last year. And let's see if there's any other number that I want to share with you. Over the seasonal norms, let's see, we usually get 176 listings, and in January we usually see 147. That's on average. So we're even below January's average. So that's just an interesting thing, that the market's really cooling down. Another good measure to look at is looking at days on market. This is how long a house goes from when a house first hits the market to when it goes pending. So it's essentially how many days buyers have to look at the house. The longer it's been on the market, it's overpriced, or there's something wrong with the house. When a house is really short on the market, it's because it was priced right, and there's an incentive for buyers to rush in, and there's a deal to be had. So let's change now to days on market, and let's look at oh wow, look at that, huh? Well, let's first look at 1 year, and this is pretty striking number that we see here. We see that days on market are now a little over a month, 31 days on market, up 416.7% from December last year. And again, these 2 previous years have been such an exception to the norm, and I can't really use these as historical data. But if we just, laugh at it for a little bit, here we saw December, the slowest time of the year, houses were on the market for 6 days. And the shortest was about 5. And that's median, right? There were some houses that were on the market for less than a couple of hours before, they got an offer and boom, they were off the market. Buyers had to rush out of the house. So it's actually a relief to see that we're going now back to, before we freak out, let's go back 3 years. No, we're right back where we were in 2020, right? We can even see higher in 2019. We saw, we got a little further back. 2019, we were on 29 days on market and 27 days on market. So we're right back to that historical level there, which is great. One thing that's causing such a sharp incline in days on market is that there's also sellers that refuse to drop their price because they're like, I want this house sold at this particular price because this is what I've been used to now for the last 2 years. And it's really hard to get buyers to come in to agree to that price because it's so much more expensive to afford a house now, either because of the high mortgage costs or because cash buyers are the ones who are typically investors, or they've been around long enough where they have had experience and they're waiting for a deal. And when they can say, hey, I got 500,000, you're selling for 550, would you like to take 500,000? The seller's like, nope. And then, well, there they are. You got somebody willing to buy, but not somebody willing to sell. Okay, our second to last data set we're going to look at is going to be month supply pending. And this is really a measure of our current inventory. Oh, it's crunching numbers. Okay. Basically what this shows is if not one more house came on the market, how long would it take for all the houses to sell that were currently on the market? So if no other house came on the market December 31st, it would take 1.7 months to completely sell the houses that are on the market currently. So that's how it works. It's basically how much inventory there is and how long it takes to scoop the inventory up. And we can see here now we're at 1.7 months of inventory, which is up drastically. Again, last year was still the housing frenzy. We're up 240% from where we were in December, which was half a month of inventory. And January we saw 0.3 months of inventory. And that had to deal with the fact there were still a lot of buyers looking and historically low mortgage rates and the fact that people really didn't want to sell. That's really the crux of it. But looking back historically, inventory is coming down as less and less houses come on the market, but there's still some buyers out there that are looking to move to Gig Harbor. If we extrapolate out a couple of years here, we can see where we are in relationship to historical norms. We're going to ignore these last 2 years and then go back to here, December 1.7. So we're right where we were in 2020. Let's go back December 18, 2.0, so 2 months of inventory. And December 2017, also 2 months of inventory. So we're right in that historical range. Also, by looking at historical data, we can see that chances are inventory will continue to slip into January and February, and probably bottoming out here in February and March. As we can see, that's happened these 2 years. And then also, 0.1 difference. It looks like those are really the troughs of the year. And so I'd imagine that we'll probably come down here to a month of, let's see. Yeah, probably to a month and a little bit over a month of inventory, I'd imagine. All right, this last data set I'm going to look at is not typically one that you use in, every single report, but it's just something interesting to look at since we've coming out of our market frenzy, and that's percent of original price. This measures, so there's a difference between percent of list price and original price. List price includes any reduction in prices. So if somebody listed a house $1 million, reduce it to 800. and somebody offered 800, that would say that's 100% of list price. However, percent of original price means that it's going to look at that difference between 800 and $1 million. So I think it's a little bit more interesting to look at to see how sellers have responded to this market. And here we can look at the top right. It says we are now 96.1% of list price. So if a home is on the market for $1 million, it's going to go for $961,000, which is down 4.2% of our December here, where we saw about 100% of asking was what buyers were able to plunk down, and that's far different than what we saw here in April, where almost 5% over. And this data is a little bit skewed. This is again median. There were some outliers, people putting over $200,000, over asking, and some crazy offers. Like, I think I heard one where it was like, you can, we'll give you a dream vacation, and kind of the going joke was, you can name our firstborn child. Just buyers trying to sweeten the deal because they didn't have any more money, so they were just trying to be creative. But it's just interesting now looking to see how far we've come from this peak here, these two peaks that we saw during the COVID housing frenzies. And now looking back historically, we are, I would say, right, a little bit less than where we see December landing. It looks like December we're looking at 97% of asking, so we're about 1% off of historical norms. Now time for some final thoughts, and I'll share with you some things about what's happened over the last year, and then some things that are concerning to me going forward in the future. All right, so just as a kind of a summary, we've had a pretty sharp correction to seasonal norms. We had this hot summer, and then all of a sudden, the mortgage rates skyrocketed, to 6.5%, 7%, and now, we're right back, boom, where we were typically. So that's kind of a very jarring situation. I would have expected a little bit more of a slower cooling, but this is less than half a year. It's been pretty significant. And going forward, I'll pull up this article. Let's see. Higher rates. Here we go. This is from the last FOMC meeting, and basically it shows that the Feds are not quite convinced that CPI has hit, its downward trajectory yet. So they're still banking for some higher rates ahead, and that will affect, of course, the mortgage rates and also affect housing prices. I mentioned earlier something about how long it takes for the Fed monetary policy to kind of ripple through the economy, and something that I want to share with you here is this graph back from the 70s. And here we can see the red is our current CPI, and then the gray is from 1966 to 1983. As you can see, we're tracking it pretty strikingly similar, and it's been extrapolated that we're going now into a decreasing CPI, but as Michael Burry and some other economists have suggested, is that we're actually going to have this double peak here. And so it'll look like the Fed is winning, and then all of a sudden it'll take some time for everything to really culminate into another inflation cycle. And that's something that's worrying me. And while it doesn't really necessarily bode negatively for house prices, it does mean a lot for how inflation will affect the price of housing. Let me just give you a little bit of an example explaining how this can affect housing prices. Usually housing is considered a pretty, an inflation hedge. Usually it tracks with inflation. So while housing prices do cost more every year, it's meant to keep on track with inflation. However, if we see housing prices stall and even go down a little bit, let's say over the next year they go down 10%, because they're supposed to go up with inflation, they're actually losing value. So if you can imagine, let's just say hyperbole here is, let's say all your costs go up. You know, your groceries, your utilities, your energy, cars cost twice as much. Let's say everything costs twice as much. But let's say your income or your salary goes up accordingly. Let's say it goes up 2x as well, or 2 times. Now, imagine that housing has stayed the exact same price this entire time, where your expenses went up twice and your salary went up twice. Now all of a sudden, housing is on a discount, even though it didn't go down in price like we expect. A lot of people are expecting housing prices to crash like 2007, 2008. However, a crash is very, very unlikely. I mean, if you look at the quality of borrowers, I mean, you look at their credit ratings and everything, you just don't see the amount of flash sellers coming onto the market that are going to flood the market with a bunch of houses with no buyers available. I think this is a lot more of a likely scenario, is where inflation will just keep ticking and ticking along like we see in this graph here, and it'll just keep whittling away at the value of a house. And so that's, everybody's waiting for houses to go down on value, when in fact they are. But they're not going down in the terms on, like the sticker price. So people just have to get their head around how inflation works and how quickly, 10% inflation can really, I mean, you look at the price of eggs. I mean, if you look at eggs and pretend like that's the inverse of housing prices, it makes a lot more sense. All right, I've said enough. Hopefully that was interesting to you. Hopefully you learned a little bit, and I'll see you next week.